Hello guys, I got a question about what's the difference between ETN and ETF. Okay, I will just I take some notes and I will explain to you. Okay, so please bear with me. As you can see here, what's the difference between ETF and ETN? Now, what does this ETF and ETN stand for? So ETF, exchange traded funds, and ETN, exchange traded notes. So what's the difference? So in practice, the two are very similar. Both are designed to track an underlying asset. Both often have the same expense ratio. It means expense ratio, most of the time it is under $1. Under $1. It means 1% of the fund. This 1% is taken by the exchange trade note company or the exchange trade fund. Okay? It's just money that it is taken from the fund. So the price of the fund will be going one down, okay, compared to the index that it tracks or something else. Now, then actively managed mutual funds. Now, understand that mutual funds are different. Mutual funds, okay, are different from the ETN and the ETF. Because mutual funds are actively managed. It means managed, it means they buy and sell stocks in these funds. But the exchange traded fund and the exchange traded notes, there is no buying and selling. Okay, except for actively managed ETF. Now, the main difference is under the hood. When you invest in ETF, you are investing into a fund that holds assets it tracks. Let's say mutual fund, okay? Let's say an ETF that tracks S&P 500. Since you know S&P 500, if I ask you, what is the ETF that tracks S&P 500? You will tell me that it is called the SPY. Okay, I will show you the chart in order to see. Okay, that assets may be stocks, bonds, gold, commodities, or futures. All these are for what we call the ETF. It could be any of these, because an ETF, it can track stocks like an index, it can track bonds, it can track gold or other commodities, or even future contracts. So whatever it tracks, it has a name and it's called an ETF. Now, what is an ETN? Is more likely a bond. It has a relation to the debt. Okay, debt and secured debt issued by an institution like a bank, for example. Okay, it means it has a big similarities with a bond. An ETN can be held to maturity, bought or sold at will. It means you can buy, you can sell this ETN. It's like a stock. Okay, it's like stock. It's like the ETF. It's the same thing. It means you can buy it, you can sell it, but it is based on the debt and secured debt. Okay, and if the underwriter, usually a bank, were to go bankrupt, the investor would risk the total default. It means if you buy this stock, ETN, and there is a bank that issue this ETN, okay, and if the bank has problems or the bank collapse, your ETN will be 0. Okay, but the ETF is different. The ETF, it is very simple. It just tracks stocks or bonds or gold, so it will never collapse. But the ETN, there is a danger of collapsing. Now, the most popular exchange traded products are ETFs. It means when you go online, you will find thousands and thousands of ETFs. One of the most popular ETN is the JP Morgan Algerian MLP Index ETN, which is called AMJ. I will show you the chart, which has an average volume of a little than 1,800,000 shares traded a day. But the Spider SPDR S&P 500, okay, which is an ETF, has more than either less or more than 85 million shares a day. Okay, so the people, they like ETFs better than ETN. Okay, so this is the difference between ETF and the ETN. So as I told you, an ETF is based, it just tracks an index or a commodity or a bond or gold. It attracts something, and it will never disappear. Okay, it's all in the market like a stock. It just attracts. It's not a big deal. But in ETN, it is a debt. It is made by underwriter of a bank. I will give you now an example how to know the difference when you are using my chart, or when you are using your chart, okay, or your broker. You should know the difference. At least you will have you will see the risk in them. Okay. Now let's go to the chart. So this is the chart. Now, as you can see, JP Morgan Algerian MLP Index ETN. As you can see here, it is written ETN, and it is 27.55, and it's going down. Now let's go and check the SPY, which is S&P 500 ETF. It's also going down, and it is written ETF. Okay, so at least you will know the difference. If you don't know, and they are like stocks. You can buy them, you can sell them short, you can do whatever you want with them. For example, this SPY is an ETF. You can, for example, if tomorrow the stock market is going down, you can sell it short, and as you can see here, 246 million. 246 million point 400,000. Okay, this is the volume, and you ask yourself why? Because a lot of traders, they trade it. That's why the volume is so high. Now, if you go to this one, it's only 2 million point 6. It means people, they don't go that much to the ETN because they are first, they are not interested in it, and second, because they don't like this kind of ETN. Okay, because of it's just a debt, and maybe if you hold it for many weeks, maybe this JP Morgan stops this this ETN. What does it mean for you? All your money is gone. Okay, so there is a big risk losing all your money that you put. But for the SPY, there is a confidence. Nothing will happen. You always have your SPY as a stock. It will never be deleted from the stock market. So your money, even if you lose little money, okay, your money is still there because it attracts 500 stocks in the market. Okay, so this is the difference between them. But for you, if you want to use ETFs, it attracts something. Now for you, let's say you want to track Dow Jones 30 stocks without buying 30 stocks. Okay, you can just go to this ETF, and you can buy it. When you buy it, what does it mean? You get the average of these 30 stocks. You know, there are some calculations, but it is the average. Okay, you don't worry about anything, as if you have bought 30 stocks. If you want to buy, let's say, 500 stocks, you can go to SPY, which is the ETF for the tracks 500 stocks. You will find thousands and thousands of ETFs in the market, because each week, each year, they will have more and more ETFs. It depends on you, what you are doing, but understand that there are fees. It means when you buy, the average, the price that you get is always less by 1% or less. Okay? So in terms of calculations, and they take some money from you. But if you buy a stock, let's say if you buy Facebook, they will take no money from the price of the stock. If you buy a stock at $10, it goes to $20, you will have 100% of your money in your account when you sell. But if you buy an ETF, understand that there are costs and fees by this company who made this ETF, like I showed you. So you don't see, they don't ask you directly, or they say, okay, you have bought SPY, which is S&P 500 ETF. They send you an email and they say, oh, you should pay for 1% or less of what you owe of this ETF. No, they will not do that, but they will take it from the price. But you don't feel it, but it is there. Okay. If you are thinking about mutual funds, they have stocks in each mutual fund. They are stocks, and they give you the average, but they take more. They take 2%, they take 3%. That's why when you own a mutual fund or an ETF, you can go to the company and you see how much they take. Okay? These are fees they take, but you don't see it, but it is there. But if you buy a stock, okay, which is better, you will get everything and they don't have fees. That's why Warren Buffett, who is the richest person in America, one of the richest, he doesn't buy ETFs. You ask why? Because, or mutual fund, he has only one stock. Okay? So he has no many stocks. But this stock has many companies, yes. But it is his own. So he didn't buy like a mutual fund. And you ask why? It's just because he doesn't want someone taking from him money, percentage. Because when you buy a mutual fund, you are spending some fees, but you don't know. The ETF, it is also, although ETF it is less expensive, it is not expensive, it is cheap, less than 1%, but still you are paying. You are paying, but it is in the fees. You don't see it, but you are paying. That's why Warren Buffett doesn't like mutual funds or ETF. He doesn't like, because they ask them money, and he doesn't like margin. He doesn't borrow money to buy stocks. He buy by his own money, and this is why he is successful for 50 or 60 years. Okay, so thank you very much for watching. If you have more questions, please ask. I am here to help you. Please share my video and subscribe if you don't, and comment. Thank you very much.